We start today's market talk. Debt markets are repricing the growing fiscal risks. So this is critical because there is a sell-off in long-term debt. When the debt is sold off, the rates go down and the yield starts going up. So US 10 and 30-year treasury bonds have declined. That is their prices, but the yields. So if you see, the treasury yields have gone up. Or 30-year, 10-year, it has broken out. I was showing you. Now it is moving upwards. Now, if you see the 30-year yield, it has crossed the last spike also. The last highs, it has crossed that. And 10-year, it is yet to go, but it is still moving up, right? So this will push the US government borrowing cost to multi-year high, and people are demanding more return for the risk they are taking. This move has led to increase in interest rates on corporate bonds in the US and in mortgages also. Now, this is being now what has happened is that the Treasury Secretary said that we will buy more of bonds and we will increase the bond buying from 2 billion to 4 billion in every transaction and maybe more. Now, how will they do it? They to buy long-term debt, which they said we will purchase, they will have to sell shorter term debt. So what has happened is, because they are selling short-term debt, so the short-term debt yield also went up. So the 2-year yield also went up. So they want to reduce the gap which is there between the short-term yields and the long-term yields. But the result is opposite. So the short-term yields have also started going up because people don't like that, and they are selling that, and also the long-term yields are also going up. So the yield curve, though it is not flattening as such, it is remaining at the similar level. So the reason, what is the reason? Higher US fiscal deficit, raising of capital by AI stocks, economic impact of Iran war, which is driving the US government borrowing cost. So these are the basic issues which are impacting. Now, what is the impact? Gold, it has broken out. You see, broken out above this $4,400 level, and it is heading higher now, and it will move up more due to inflation hedging and excess liquidity which is expected. Silver, it has now moved to the resistance level. So it has broken out from this 66 odd level and has now reached that resistance of 70. And one odd day with good buying, it may break that, and then it will higher. But the biggest move has come in cryptos. The Bitcoin was up 25% last week. Now, what happened here? It is right now pushing towards 80, driven by spot ETF inflows and huge sentiment towards risk-on rally. The reason was that firstly, it broke that resistance, which was at $64-65 level, 64,000 level, and then broke the resistance, which was 70,000 level. So short positions got liquidated, pushing the prices higher. Now it will consolidate, but with another push or another liquidity put injection in the US to support their economy, it will head higher. Now the market outlook, yield on government bonds surged across many economies. So long bond yields in US, Japan, Germany, France are at their highest in decades. Concerns are over inflation due to stalemate in Strait of Hormuz. Rise in government borrowing. US government debt is now around 128.6% of the GDP, expected to rise due to higher military spending, rising interest rate burden, and incentives for reshoring production and subsidies for technology. So all governments all across the world are doing higher military spending, higher borrowing just to run the economies, and providing incentives to industries and businesses for reshoring production, subsidies for technology, etc. Because everybody wants to do the production within their country. Hence, the government bond yields have to rise. So this is a permanent trend, and you can't keep the yields at the lower level for very long, because investors who are buying bonds, they want better returns. Now, what is the immediate implications of this? Elevated US Treasury yields have pushed the hurdle rate of return required from Indian markets beyond their projected upside. Now, this is one of the reasons that FIs are unlikely to reverse selling of Indian equities. As I showed you, 10-year yield in the US is at 4.7. So you buy 10-year bond, you get around 4.7. Add equity risk premium of 5% to that, and then add 2 to 3% Indian rupee depreciation. Hence, the hurdle rate which I was talking about for return for Indian equities expands to around 11.7 to 12.7% in dollar terms. Now, return expectations for FY27 are 9 to 10% only. Hence, foreign allocators have little incentives to step in aggressively. Hence, don't expect a return of FIs to Indian equities immediately. This is the immediate effect of rise in bond yields. On top of it, India continues to command rich multiples of PE and PG also, that is PE to growth. But the only savior is that the mutual fund money will keep valuations anchored to the present levels. So that is what is market is reflecting nowadays, that it is in a kind of a stalemate position with no directional move. Now, talking about AI, in my opinion, one of the reasons why the AI hyperscalers will not make money is because of competition, which is becoming stronger and stronger from China. So the companies that use AI better, well, and bring down their costs without going in for huge spending and capex, which AI developers are doing, will outperform. So one has to find those companies which are able to use AI better. Now, if you see last week, the Brent crude still went up around 5%. So it is not coming down. It is at around 93, 95 level. Dollar index came down, but it is, in a kind of a range bound due to higher yields. If the yields are higher, more money goes into the US, so the dollar actually strengthens. So it is somewhere in between because it is not really reflecting the actual thing. But it is where it is. Copper, it is bullish due to demand, due to green transition and data center expansion. So it will keep doing well because this is one metal which will remain in demand. So the US indices close lower. So if you see here, the US S&P 500 has come to that support from where it had broken out. Nasdaq has not been even able to make a fresh high because of concern on AI spending and return on investments. And Dow also has come back to the support from where it had broken out. So the US indices are also not moving. But the other asset classes, cryptos, gold, silver, etc., are heading higher. They are surging. So probably the smart money is moving there. Now coming to FIDI data, we are heading into expiry now. So if you see here, FIs are net short on index futures. They have sold index call options, bought index put options. So they are medium-term bearish. Pros, net long on index futures, bought index call options, bought index put options. But the index put options which they have bought are more than combined of futures and call options. So they are mild bearish. Net, they are bearish. Clients, net long in index futures, bought index call options, sold index put options. They are strongly bullish. So position is very clear right now. Let's see what happened during the week. So this week on 14th August, we ended at 1.77 lakh short positions in index futures by FIs. So they have gradually increased their short positions throughout this week with some kind of profit booking closer of the short positions on Friday. And because of that and the bearish actions in terms of options also, index Nifty came down. It made a low, and then in the last 2 days they were short covering, and then it has gone up also partly because of US action, but it has not really gone anywhere right now. Now coming to the Indian markets, US dollar, Indian rupee weakened. So it is again moving up. It has moved up. It had corrected or it has strengthened substantially, but now it is moving up. Bond yields are also spiking up. It is up 1.24%. So people are expecting some kind of rate hikes in India also because inflation expectations are high. Let's see what happens here. Now, this is what I want to talk about. India VIX. You see, it went below 10 this week. Total, it is showing total complacency. I'll show you why. What are these stars? These stars are the places where it went to these 10 below 10 levels earlier. All of them were corresponding to market tops on Nifty, right? So it made a top in September, October 24, and in November, December 26, and maybe early January also. So the bottoms of these wicks are the market tops. Now it has come back again here. So one has to be very careful because right now it is showing total complacency and trying to reflect that maybe we have made a short-term high or top. Now Nifty, if you see the Nifty chart, this is a weekly chart. Uh, Last week it ended lower for the second week. It made a small bodied candle with a minor lower shadow. So there is lack of strong commitment from both bulls and bears. Let's see the daily chart. So it broke out from this 24,600 level and then it has deteriorated constantly. Then from the lower levels of 24,000, it bounced a bit. So right now, in my opinion, 24,400, where this 200 EMA is, and 24,000 should be the resistance and support for this. Now, I was covering about autos and IT earlier. Both are now getting halted. The movement is getting halted. The one index which is showing some momentum is metals. That is because of higher liquidity, lower dollar index, etc. So the metal index is the one which is now showing some momentum. Watch out for this and the constituents of metal index. Nifty Bank again is not gone anywhere. It is consolidating right now. It was positive last week, basically because of some positivity with respect to HDFC Bank on the Friday. So if you see the bank index, it has not gone anywhere. It has major resistance. And in my opinion, right now, 58, this 200, 300 level is the resistance and support is at around 57,200 or 57,000. 57,000 was the bottom of this week. So 57,000 to 58,000 plus. So it is remain range bound and it is not showing any momentum. And same is there with RSI also. Now, mid-caps halted a bit, but last week they had made a fresh high. So this is where the momentum is and where the earning support is also. Small caps made a fresh high, so they are doing well. And this is where one has to remain invested and keep this breakout zone as the stop loss in case you are invested in the small cap. Mutual funds because here the people are in profit, so they will be selling will also be big moment in case the market turns. So net if you see HDFC Bank, these are major stocks, so it is taking support here. It went below this support, but it has bounced back. Some buying will come now at these levels, but it is not going anywhere. Similarly with Reliance, you see made a doji, not going anywhere. RSI is also around 40, 45. So there is no trigger for these stocks to go up. So net, what is the impact of rising bond yields? Four impacts. First, FI's outflow and capital reallocation. Capital get reallocated to US, etc. because it is safer. Then second is currency depreciation and imported inflation. So inflation will go up. High PE stocks undergo valuation derating because in DCF, you divide by the cost of money. So if the cost of money keeps going up, the P has to contract. Then higher cost of borrowing squeezes the corporate profit margins. So the corporate margins go down because the higher cost borrowing cost goes up. Hence, one has to be careful right now. Now I'll cover two stocks. First is Genus Power. Uh, it makes smart electricity meters, pioneer in smart metering solutions, and leads India's power sector transformation with its innovative and comprehensive range of smart electricity meters. Now, I was wondering why this stock is in so much of momentum. The reason is that it is diversifying into smart gas meters and smart water meters also. Hence, it was in momentum. I'll tell you why. It's a leader in electricity metering solutions in India. Government of India has approved an incentive scheme for the promotion of domestic PNG connections effective 1st September 26. The scheme is designed to fast track the expansion of domestic PNG connections. PNG is piped natural gas. So PNGRB, which is Petroleum and Natural Gas Regulatory Board, has proposed a roadmap to mandate smart prepaid gas meters for all new DPNG connections. DPNG is domestic piped natural gas, with a gradual phase out of the conventional meters for existing users, also new connections and take out old connections. So they want smart meters there also. So cumulative opportunity for smart gas meter manufacturers is around 35,000 to 40,000 crore over the next 8-9 years. This Genus Power is well positioned to capitalize on this opportunity through its diaphragm gas meter G1.6 SKG16, which is already compliant with PNGRB specifications. Its smart gas metering ecosystem includes G-Setu, a retrofit meter interface unit that transforms basic gas meters into smart meters. It has a robust order book of around 24,000 crore on Q1 FY27 and provides strong revenue visibility over the coming years. Management also expects to see improvement of 50 to 75 days in working capital days. Now, what are the risks? Advanced smart meter implementation requires significant upfront capital for installation before annuity-like concession cash flows begin, pushing borrowing and working capital needs higher. This is the cash flows is the only problem why this stock has been floundering for the last 1 or 2 years. Execution and client concentration performance relies heavily on state-owned discom execution schedules and timely payment collection cycles. So if you see, last quarter, the revenue was up 45%, EBITDA was up 30%, margins was lower because of higher input cost, and profit after tax was up 26.7%. So last quarter was very strong, and when the results came, I was wondering that the stock will break out, but it didn't move. And then suddenly, once this announcement of gas meters, PNG connections to the complete households came, and then the stock started rallying. So what is expectation? What is the guidance? Is that revenue to expand around 18% CAGR over the next 3 years. EBITDA to also expand at similar rate. So that means margins will remain stable, north of around 18%. Finance cost will continue to improve as percentage of sales. So finance cost is coming down. I'll explain it later with cash flow statement. And PAT is expected to grow at around 20% CAGR over the next 2-3 years. Stock from its average valuation PE is now one standard deviation below that. So there is a value here right now. Okay, so let's come to their expectations of earnings. See, it is expected to do, as I told you, 24,000 crore is the order book right now, and a big opportunity, at least 5-6,000 crore is the opportunity in gas meters every year. So it does a revenue of around 6,000 crore. It is expected to do 6,000 crore in FY27. So it's expected to do around 26% revenue growth next year, but it will stabilize around 15 to 18% after that. EBITDA growth of 22%. Now the key issue is the financial expenses are expected to go up, not coming down. So this is the finance cost. That is a cost due to the borrowing. PAT growth of around 18 odd percent may go to 20 odd percent later, but this is what is expected. Now in FY27, EPS should be around 23, 24, may go to 28. So this stock, if you see, is at around 14, 15p right now. EBITDA margins will improve. So what is the problem with this stock? This is the balance sheet. If you see here, first is debt. Now debt is rising. It is somewhere around 2,400 crore and not expected to reduce. So because the capex cost is high. Then the other problem is this the net working capital, current assets, the inventory buildup, because they have to execute so much of orders. So their current assets are roughly around 5,000 crore and are expected to go up. So this again is a blocked cash, and then there is a cost because of that, because they don't get money, and net debt is expected to go up, etc. So this is the reason why this stock is subdued. Now let's come to their cash flows. Now FY26, you see the operating cash flow was negative because higher net working capital. Net working capital is high because there is delay in money coming to them from the users, and also higher inventory cost. So operating cash flow was negative. Capital expenditure was there. They raised debt, so they paid higher interest. So the free cash flow to PAT was negative 152%. So that means their cash flow was negative with respect to PAT. So they didn't get any money in their account as such. So they had to borrow. So the profit is a paper profit actually. Now for the next year, FY27, because there is going to be lower requirement of net working capital, so operating cash flow will be positive. They would have to do lesser capex, and there is expectations of some acquisition of companies, etc. So that will take the money, cash. Rest is okay. So it will become free cash flow positive now, hopefully in FY27, but we'll have to wait for this. So this stock is right now at around 14 times FY27 and around 10, 11 times FY28. So not very expensive. EV EBITDA for FY27 is below 10. So there is a value here. And as they have said that they will bring their net working capital days lower. So they are trying to bring those days lower. So this is the issue right now. So one has to watch for this, and that is why this stock is at lower valuations. Now, if you see here the chart, this is a weekly chart. So this stock has seen much higher levels above 400 and has been on a declining trend line. And now from this, it was consolidating at these levels, around 300, 290 levels for a long time. And from here, it has broken out with volume. So once it breaks this trend line, then it can go higher. Now, see, we are talking about 28 EPS in FY28. And say, so mean of FY27, 28 is around 25, 26. At 15 times, it can easily go to 420, 430. So this should be somewhere the target for end of this year. It can go there once they execute well and take care of their costs. Now the other stock is B2 retail. So see, it's basically a apparel maker for men, women's, and kids wear, accounting for 85 to 90% of their sales, supplemented by non-apparel lifestyle products and general merchandise. But basically, this is a apparel seller. Now the strategy is low margin, high volume model positioned directly against unorganized local markets and organized value peers. So their competition is with Zudio, VMart, Style Bazaar, etc. Now compare the valuation of Zudio, etc., and compare this with the growth they are having, and then you will see where the value is. So the what is the factors which are driving apparel business? First is occasions drive for various functions, functional need, that is old clothes, fashion, etc., going to office, वगैरह. Then emotional needs, new season, new trends, fun time, new reels, etc. Then brand recall, price, quality of make, quality and type of fabrics, durability, comfort, fit, etc. So good brands, they get sold. So this V2 is basically value and variety. So this is what is driving the apparel business. Revenue mix is very interesting. I was very surprised actually that the 41% of their sales is to men, not ladies. Ladies is 28%, kids is 24%, and lifestyle like deodorants, wallets, sunglasses, ladies' purses, etc. is just 7%. So 41% is to the men. Lowers, uppers, occasional wear, winter wear, sportswear, formal, casuals, etc. So this is what they are selling. Now they have stores across India, strong presence, 381 stores. States region covered are around 25, cities covered 300 plus. Pan India presence, mostly in this part, Eastern Belt, Uttar Pradesh, Bihar, Jharkhand, West Bengal, Odisha, Assam. So this is where they are concentrated more on and trying to expand to other parts of the country. But they are all over the country. They have their hub in Gurgaon. Now, what it does is it continues to execute well in value fashion retail segment with robust revenue growth, healthy store additions, strong full price sales contribution, and improving customer repeat behavior. Company remains well placed to benefit from organized value fashion penetration in tier 2 and tier 3 markets, backed by private label control, rapid expansion, and improving analytics led merchandises. Strong 3-year revenue growth. So they did around 54% CAGR revenue growth, and profit grew around 137% CAGR, propelled by aggressive store expansion into semi-urban markets and rising demand for value fashion. Q1 FY27 consolidated revenue grew 58% year-on-year to 997 crore, driven by rapid store expansion, healthy customer traction, and 56% year-on-year volume growth. Management has reiterated that FY27 target of 170 to 200 store additions, 8 to 10% store sales growth, and at least 50% revenue growth funded through internal accruals, cash release from creditor normalization, and bank limits if required. So they are not going to borrow much. New stores are currently generating 730 to 740 rupees sales per square feet. So the new stores take time to come to the level of old stores, while mature stores are operating at 1070 to 1100 sales per square feet. But they have to spread themselves because there are enough number of tier 2 and tier 3 towns in India. New stores are therefore at around 65 to 70% of the mature store productivity. It opened 57 stores and closed one during Q1 FY27, taking the store count to 381 and retail area to around 40.7 lakh square feet as of 30th June 2026. It has crossed now 400 stores nationwide. Now coming to earnings last quarter, so if you see they did around 57.7% revenue growth, 56% EBITDA growth, PAT was up 70%, margins were slightly lower but stable at around 14%. So this line of growth is expected to continue. Now, as they keep adding stores and get into new territory, so sales per square feet was slightly lower, but average selling price is higher and average bill value is also higher year on year. So this is just one of the metrics. So if you see strong revenue growth trajectory, revenue has nearly become 70-80% year on year. EBITDA and EBITDA margins have improved. So they are also improving. So it has reached 14% plus. PBT is nearly doubled now. Profit before tax and profit after tax also was up nearly 2.5 times. So it is showing good trajectory, and you can see the path of growth for this company. Operating metrics, store count is improving. Retail space is improving. This was as end of FY27, so this is improved from here. Sales per square feet are going up, and rent per square feet is coming down. So they are becoming more efficient. Operational parameters, inventory days have gone up, so the money gets blocked, but creditors days of sales are lower. Net working capital days have moved up, and return on equity is also higher. So return on equity is higher. That means they're generating good cash. Now let's see their future projections. Revenue is expected to grow around 50% in FY27. So this is in crores. So 4,677 crore they will expected to do. Margins around 14%. Adjusted EPS of 6.4 from 4.1 now, 6.4 adjusted EPS. So the PE comes to around 34 times. So it is below PG of 1, because if it is, the profit after tax is expected to grow at least 50% from here. At 34 times, this is not very expensive. EV EBITDA has come down 13 odd, and for FY28 it is below 10. So there is a value here. ROC, ROE, etc. are improving. Return on net worth is also high, so it is good. Now let's see this chart. V2 retail is made a high of around 260. Now it is consolidating here, but one has to worry about this. It is consolidating, but there is a value here. At every dip, it becomes a buying opportunity. It is just consolidating because the market is consolidating. So right now, nobody is looking at it, but this is the best time to get this stock. There is a value here. It last week, so if you see, it went from uh, high was 226, low was 215. So it is just consolidating here. So every dip is a buying opportunity. I finished. We will take questions now.